Okay, accounting students, this is part three, our last video for chapter number three. And before we take a look at goodwill impairment, let's take a step back in the previous slide. You remember all these different adjustments, including now this E, where we had to record additional amortization or depreciation, or even a reduction in our example to the depreciation expense. And all of that was due to the fair value of the assets being different than the carrying value on the books of the sub. Okay, that difference is then amortized under this adjustment E. But how about a difference in the liabilities of the sub, the fair value of the sub's liabilities as compared to what's recorded on the books of the sub? And I think there was a brief example in one of the this or past chapters. So here it mentions that if the long-term liabilities of the sub are not just exceeding but different than the fair value of the sub, we need to amortize that difference. And I think this is pretty much the same, almost the same type of adjustment. If you remember back in your previous accounting classes, when you had a premium or discount when the company issued bonds, yeah, bond payable premium, you would amortize over the life of the bond, reducing the interest expense. Or if you had to amortize a discount on the bond payable, you had to increase the interest expense. So in this case here, at the time you set up the liability on the consolidated basis and it's going to be bigger, the fair value bigger than the carrying value of that liability on the books of the sub. That difference is going to be amortized, reducing the interest expense overall for the consolidated group. And that's kind of just summarizing these three paragraphs here or one page in our textbook. It's almost like thinking backwards in the case of the assets, yeah, now here liabilities. But let's move on to goodwill impairment. So since we were not amortizing goodwill or some other intangible assets like the, was it patent in this comprehensive example for our chapter 3, what we gotta do every time we need to prepare a consolidated financial statement is to determine whether there's an impairment for these intangible assets that have not been amortized. Of course, we're following FASB GAAP rules, yeah? And the rules for international standards are a little bit different that we'll see in the coming slides. So, what's the procedure now we need to follow to determine whether there is an impairment and the dollar amount we need to record as a loss? You're never going to get a gain, yeah, when the goodwill actually increases in value. I don't think that's possible. But if you have a reduction in the carrying value, fair value of the goodwill compared to carrying value, we need to record the loss amount. And we don't really go through any detailed calculations here in chapter 3 to get that loss amount. If anything, they just tell you what that loss amount is. And we have to be able to journalize that as a operating loss expense. Okay, we're allowed to first do something called a qualitative testing to determine whether there is a impairment or not before we do a detailed quantitative dollar amount calculation for the impairment loss. And here it mentions that if we think there is a potential of the fair value of the, it's not just the goodwill asset itself, but the reporting unit, a part of the whole company that has allocated goodwill, whether that fair value of that reporting unit is less than the book value of that reporting unit. Then there's going to be a loss. Here they say it should be more than likely that's the situation, or more than a 50% chance that's the situation. So if that's true, then we got to go ahead and try to calculate out that impairment loss. So maybe your so-called reporting unit, not the whole company now, but you're chopping it up into different reporting units as shown maybe as a line item or a note to your financial statement, or maybe even something internally within the company. Yeah, reporting units. Typically, reporting units for a large organization may have like vice presidents, yeah, for each unit. And if the value of the assets or net assets in that reporting unit, that's called carrying value, is less than what it's worth, fair value, then you have an impairment for that unit. Yeah, keeping in mind that the carrying value should have its share of goodwill costs, yeah, goodwill assets in here. So we calculate out the fair value for each unit. In other words, you don't do this analysis for a company overall. You have to do the analysis per reporting unit. So you cannot offset a, loss in one unit with maybe even a possible gain in another unit. Yeah, you don't report the gain. Yeah, you report losses. So um, typically, like a worst case situation, only report losses per unit and not offset it with any gains per unit reporting unit. So let's look at the example. This is, I believe, in our textbook. So at the beginning of the year, this is when we're going to form the consolidated group. We have a holding company called New Call. I think on the next slides, for whatever reason, they changed the name to, let me go to the next page. They call it Procall. That's the same company. They just got it mixed up here. This is Procall, and it forms a couple of subsidiaries. One is this DSM, and another is Vision Talk. Yeah. So this is the parent, and it has two subsidiaries. And this DSM subsidiary has two different divisions, one called Wired and one called Wireless. And according to our accounting rules, what we got to do is allocate the goodwill asset among all the different reporting units. Oh, and there's this other one, yeah, other subsidiary. So the reporting units are Wired, Wireless, and Vision Talk. Each has to be allocated its share of the overall consolidated group's goodwill asset. And we think there's probably, and this is the total goodwill for the whole company. And here on the next slide, it shows you the allocation of that overall amount to the different reporting units. And now, every time we need to prepare a consolidated financial statement, we need to analyze whether there's an impairment of goodwill by each of these reporting units. We have an indication here that the wireless reporting unit is not doing well. Here is the book value, the carrying value of wireless that includes the goodwill asset. And here is how much we think it may be worth fair value. This is done, and we don't get any detail, but the textbook gives examples of how maybe this is calculated, called a quantitative um, assessment. Yeah. Qualitative means we just have an indication there's a possible problem with goodwill impairment. And to calculate out the dollar amount, we go through a quantitative procedures. And here is the amount we just figured out. This should be easy to figure out because this is on your records already, yeah, the book value. And because the fair value is less than the book value, the difference, this $70,000 difference, should now be recorded as an impairment loss, as a deduction, as an expense in the operating sections of your income statement. Yeah, not that in that other comprehensive income, but here regular loss, regular deduction of $70,000. What 70,000? $70 million. Different rules, slightly different rules for international standards. Instead of using reporting units under US GAAP, here IFRS uses cash generating units, I guess based upon cash flow for each of these units here. And they don't use the qualitative assessment like we do here. They go straight into some type of quantitative, uh, qualitative dollar amount to figure out for each unit here. Okay, cash generating unit. Okay, and you can read this like again comparing U.S. GAAP with IFRS reporting units up here and cash generating units over here. The next set of slides just mentions that besides the goodwill asset being impaired, there can be other intangible assets that were not subject to amortization that can be impaired. So you got to go through the testing for these assets also. But let's jump to the last section of chapter 3 that deals with contingent payments going to the sellers of the subsidiary. Maybe you didn't pay the money up front. Maybe you didn't issue out the parent stock up front in exchange for acquiring the sub. And if you are going to be paying off the old owners of the sub within a year, then this section here probably doesn't apply to you. But if the payment is in over a few years here, future payment or payments, then the amount that you may owe them may vary depending upon how well the subsidiary is performing. Okay, so you at the time you purchase that sub, you're gonna make your best guess of how much those future payments are gonna be. But over time, maybe that future payment is going to change. And it's kind of strange because you want the sub to perform well. But if that's the case, maybe you're going to owe more in the future and you have to report now an additional amount of cost recorded as a loss for the current year's increasing in liability you're eventually going to be paying. Or maybe the sub is not doing as well as you thought it was going to be doing, and you're going to be owing less, reducing the liability you're going to owe. Thus, that's reporting maybe as a gain, even though the sub is not doing as well. You want the sellers of the sub to help you promote your overall business, keeping good customer relationships, keeping good relationships with the banks, and even your retaining your employees. Thus, the sub is doing better, but now you're going to owe more, and you gotta record that owing more costs currently this year, each year, really as a loss. Would and in a way that would be good because now your sub is doing well. Okay, so that's the end of our chapter 3 video lectures, yeah? So go ahead and work on your smart book assignment. I think I just set up only one spreadsheet as homework assignment for this chapter 3. I tried doing the others, but I found mistakes in the solution, so I didn't really assign it. Okay, and then of course you're going to be taking your quiz. So email me if you have any questions. I'll talk to you later in chapter 4.